if the Fed actually pivots to some degree and starts signaling that there's going to be 3 cuts in the last quarter of the year, then that's going to be a big surprise. It's probably going to have a big impact.
Because they don't want to repeat, let's say, the mistakes of the past.
Why are we talking about this now? Why are we talking about higher for longer now?
Tariffs, geopolitics, financial aid to foreign countries. It's not just inflation, GDP and employment. Now you have external factors.
There was that period around the initial oil crisis where inflation massively spiked.
EURUSD pair is still pumping, is still rising.
What do you think this means for swing traders? What do you think it means for position traders?
It becomes a little bit more difficult to keep a clear head.
How do you think that this kind of environment, higher for longer, affects traders' psychology?
It's also harder to hold positions because all of these external factors come into play now.
Hello and welcome back to Trading Talks. Last time in this series on monetary policy and central banks, we looked at surprise changes in interest rates. And today we're going to be looking at the psychology of higher for longer. What is higher for longer? How does it interact with the context in markets generally? What that means for swing and position traders, and looking at a couple of relevant charts. If you haven't done so yet, I would encourage you to subscribe, turn on notifications so that you can be aware as soon as the next podcast in this series is released. I'm Michael Stark, Financial Content Leader, and joining us to give us opinions today is Antreas Themistokleous, Trading Content Specialist. Welcome, Antreas.
Hello, Michael. It's happy to be here.
Cool. And I suppose the main question here is like what's high and what's long. So can you give us just kind of a brief overview of why are we talking about this now? Why are we talking about higher for longer now? What's happened with primarily the Fed the last few months?
Sure. So higher for longer, it means that we have prolonged periods of higher rates, right? And this is kind of a shift of what used to happen because previously in previous cycles, when we had higher inflation, we had a reactionary increase in rates, correcting what was happening and then coming back down.
Yeah.
It was more of peaking, controlling, fixing what's happening with inflation and then coming back down. Whereas now, because we have stickier inflation, let's say, we see this phenomenon of higher for longer, meaning prolonged periods of higher rates rather than, correcting and coming back down.
Yeah. And the comparison that's often made, what's happened within the last few years after COVID, comparison that's very often made is if we take a really long-term chart of inflation and we look back at the mid-70s and the late 70s, there was that period around the initial oil crisis where inflation massively spiked in very many developed economies. And the central banks, they hike rates to try to bring it back down and seemed to be more or less successful, but then started cutting again too soon. Then, of course, inflation resurges again. And towards the very end of the 70s and into 1980, then it reaches another peak of inflation. So I think that's the important context. That's probably the main thing that we can compare with. And I imagine many people in the Fed and other central banks are actively comparing with. They don't want to make this kind of mistake again.
Yeah.
They don't want that to happen to get at any cost.
And that's why we see this cautiousness by the Fed or not willing to cut rates as soon as it was expected.
Yeah.
Because they don't want to repeat, let's say, the mistakes of the past.
Yeah, exactly. Makes sense. And inflation is one of the most important regular releases of data that we're looking at within the context of higher for longer, right? But what others would you highlight? Would you put any particular emphasis on GDP or on jobs or on something else, industrial data or trade data even?
Yeah, sure. So you are right. The number one metric that they are using is inflation, probably PCE index also. But the major ones are inflation, GDP, because you get an image of how the economy is doing, and the labor market. For the USA, we have the non-farm payrolls and the unemployment data, which are published together, is the US job report. So these are the three main metrics, let's say, that are used by the central banks.
Yeah. And I think something else that's important, although, we looked at it, of course, in 2021, 2022, is purchasing managers indices, because that could be one of the potential early signs of inflation rising or falling. Yeah. So, but that's a slightly separate topic, right? And within the overall higher for longer, one of the reasons that we can talk about this is that there isn't an imminent risk of recession. You know, much of the time, the central banks, they have this kind of juggling sort of to do between making sure inflation doesn't get too high while also not damaging economic growth.
Yeah.
And so in that regard, the current situation is a lot easier than it was in the late 70s, because growth is okay-ish. There's some degree of growth in most countries. Yeah.
Yeah, now we have external factors, for example, tariffs.
Yes.
Or geopolitics, or financial aid to foreign countries, and all of that. So it's not just inflation, GDP, and employment. Now you have external factors as well affecting that also.
Yeah, exactly right. And that's why I think in particular, if we look at something like euro-dollar, for example, you would think in the context where the ECB is still cutting its rates, whereas the Fed is definitely higher for longer, you would think euro-dollar would be going down just on those factors. But it's not just those factors. It's also politics. It's also trade and various other things. But let's come back to that in a minute when we look at the chart. Yeah. So what do you think this means for swing traders? What do you think it means for position traders? I mean, does it give them basically more opportunities or fewer?
Yeah, so for swing traders and position traders, because they are trading in the long term, it would take more patience now with all these fluctuations, let's say, that are happening to keep a clear head. It's also harder to hold positions because all of these, external factors come into play now. So for longer traders, I think it becomes a little bit more difficult to keep a clear head with everything happening, not just the monetary policy staying stable, but also other economic factors that come into play.
Yeah, that's right. So let's pick up on that a little bit and talk about psychology. How do you think that this kind of environment, higher for longer, affects traders' psychology? I mean, how does it affect, I think probably the main thing I would think about is their discipline and their ability to react quickly, but also appropriately when the narrative kind of changes. Or anything else relevant.
Yeah, it also creates, frustration.
Yes.
Because when you have stable rates, then you don't have the volatility that moves the market to the direction possibly that you are trading with. Also, it creates fatigue because you don't have trends forming because you have stable rates now.
Yeah.
There's no big catalyst that moves the markets. So I think that's the two major symptoms in the psychology of traders now.
And I think also, to some extent, maybe it can generate a bias in that now we've got this higher for longer narrative. Okay, everybody's expecting the Fed, if anything, to be pushing back cuts further, right? If, and I don't think it's very likely, but if the Fed actually pivots to some degree and starts signaling that there's going to be 3 cuts in the last quarter of the year, or even if there's going to be 4 cuts from July until the end of the year, which is not very likely, then that's going to be a big surprise. It's probably going to have a big impact on a lot of people, even though in itself it's not that much more surprising than if the Fed postpones them further. People are kind of trying to anticipate the direction of the surprise. So if it goes the other way, then that's something that might have a much bigger impact, than in itself it would suggest.
Actually, I think it's most probably for the opposite to happen. Instead of the Fed thinking of cutting rates, probably it should start thinking about hiking them.
Yes.
Because if the USA especially gets involved into all of the geopolitical tensions that are happening in the Middle East, especially, I don't think we're going to be thinking about cutting rates anytime soon.
Yeah, that makes some sense. So let's look back to the chart. And I think the main chart that I would like to look at would be euro-dollar. Because as we were talking about earlier, if you just purely consider monetary policy, if monetary policy is the only thing that's happening, then you would expect this to be a fair bit lower, I think. Yeah. But the other factors, how do you see higher for longer tying in with the other factors? And what do you think are any kind of particular point or two that you would highlight about this chart?
Yeah, so you would expect that because the Fed hiked rates and the ECB started cutting at the same time, that the euro-dollar pair will be in an overall bearish trend. But what we see now, because we have this higher for longer, we see that and also the ECB is still continuing cutting. But on the chart, on the daily chart, we see that the EURUSD pair is still pumping, is still rising, and it broke the medium-term high around the 1.15 recently, and is still trading above that area. So given the new set of environment or set of data, if you wish, I don't see any major signals of a trend reversal, at least in the short term, on EURUSD for now. So I am expecting some sideways movement before we see any, major catalysts. We have the Fed's meeting coming up. We have escalations in Iran-Israel conflict and the possibility of the USA getting involved. So if it does, then the whole image will shift on EURUSD. So nobody can tell for now. We're in dangerous waters.
Yeah, quite, yeah. Well, I mean, there's always some degree of danger. Yes, that's true. And next time, we'll be talking a little bit more about divergence between central banks. So thanks very much, Andreas, for coming on, for sharing your insights.
Thank you very much.
And to those of you watching, please join us again for the next podcast, at which we'll be discussing the divergence between central banks and how it's possible to change these. If you've not done so already, subscribe, turn on notifications so you're aware as soon as the next podcast is released. Hopefully see you there.